Ladies and gentlemen, we are watching the Federal Reserve reenact the final chapters of the Roman Empire, and while the American government is trying to print their way out of a 50-year debt spiral by gaslighting retirees into buying 4% bonds, Michael Saylor is selling preferred stock backed by God's money, and he's buying more of the scarcest asset on earth with all of the raises. STRC is his product. It is the Trojan horse. It is the yield-bearing NASDAQ-listed wormhole that allows the fixed income boomers to unknowingly finance the most aggressive corporate Bitcoin accumulation in the history of the world. You want fixed income? Great. Saylor will give you 11% dividends paid monthly. And if Saylor continues to want the fixed supply of Bitcoin, perfect. He will take your dollars and buy Bitcoin that nobody is selling. And the best part is why this is great for Bitcoiners, because this is forming a persistent bid on Bitcoin itself. Saylor is going to drive the price higher. He has built the pipes from the fixed income capital pools into Bitcoin. Every single dollar that flows into STRC is going to get weaponized into a supply shock on an asset that we know doesn't dilute, doesn't default, and doesn't care about any ETF flows. This is a simple pitch. They literally said, what if we turn the $7.7 trillion cash equivalent market into a machine that buys Bitcoin every single time that there is a fixed income investor that wants yield? And that's what STRC, also known as Stretch, does. And this stopped being theory about halfway through last year, but right now it is live, it's tradable, it is an SEC cleared instrument that has already raised billions of dollars. And if just 1% of this little money market crowd, if they shift their cozy little 30-day T-bills into one of these Bitcoin covered preferreds, you're talking about hundreds of thousands of Bitcoin vanishing from the supply forever, and price reflexivity that makes your head spin. You want $1 million Bitcoin? The money has to come from somewhere, and guess what? You don't need a new halving or a Fed pivot to cut more rates. You just need Saylor to keep printing Stretch and for the retirees to keep clicking buy. This title is not clickbait. Let's begin the analysis. Let me paint the landscape for you. Saylor's not pitching to the crypto degenerates out there huffing dopamine on their Solana meme coins. They are aiming directly at $7.7 trillion of money that is so conservative it flinches at a 5-year CD. This is the capital that wakes up at 6 o'clock a.m., drinks black coffee, and logs into Schwab to make sure that the 30-day T-bill ladder hasn't moved too much. Now, if you look at the contrast, there's $7.7 trillion in U.S. money market funds alone, $145 trillion in global fixed income, and then we have to look at Bitcoin's entire market cap, which is $1.81 trillion today. So when we look at the math right here on this screen, we can see that Bitcoin is 1.2% the size of the entire bond market. That is it, 1.2%. So if Stretch from Strategy can redirect even the tiniest sliver of that conservative capital into Bitcoin, just 1%, that alone would finance the acquisition of over 850,000 Bitcoin at current prices. That's 200,000 more Bitcoin than Strategy currently owns right now. That is more than 4% of all the coins in existence, gone, absorbed, and never coming back. And even if a 0.5% of global bonds flowed into Stretch-style yield structures, you are looking at a demand wall big enough to consume multiple years of global Bitcoin miner issuance. And this is the same capital that's already starting to chase stablecoin yields, tokenized T-bills, and anything that doesn't involve Jerome Powell lurching into the debt markets with a fresh bucket of IOUs. These people, these investors, they want short duration, monthly payments with stable par values, and Stretch is giving them that, but with Bitcoin under the hood powering it all. You don't even need the entire bond market, you need a crack in the dam, because when that capital starts to flow, even modestly, it dwarfs Bitcoin's float and kicks off a supply shock that not even the ETF crowd is ready for, and this isn't a theoretical bridge anymore between TradFi and the crypto scammers. It is a live NASDAQ traded asset that is saying, would you like 11% yield and for us to buy Bitcoin with your cash every single month? And judging by the size of the pools, that it is targeting, Michael Saylor is just getting started. So now it's time to look at the penetration scenarios, the United States money market rotation, because this is where it gets pretty disgusting in a good way. We're not talking about fantasy here. We're not talking about hyperinflation in some country. We're talking about what happens when just 1% of conservative, yield-hungry capital rotates out of a money market fund and into a par-anchored 11% dividend monthly paying preferred share that buys Bitcoin with every single dollar. So let's look at the numbers. We already said at just 1% penetration, that is $77.3 billion raised, instantly converted into 860,000 BTC. Remember, the US money market is only just a sliver of the global bond market, and this is just 1% of the money market. That is a number that is bigger than the net asset value of Strategy right now. So at 1%, that is over 4.3% of the entire circulating supply of Bitcoin totally erased. At 2%, you are over 1.7 million Bitcoin gone forever, locked up, never to be sold because there's zero incentive for the corporations to ever sell Bitcoin. And at 5%, you are looking at 4.3 million Bitcoin, 21.5% of the circulating supply, permanently vacuumed off the markets. Now, obviously, they're not going to be able to buy Bitcoin at the same price because this is going to drive the price up, especially with an order that large. But that's my point. This is creating a persistent bid on the Bitcoin price from the fixed income market to the likes that we have never seen before. This is what adoption looks like. This is the digital gold rush that we have been waiting for the asset. Bitcoin is being monetized. It is being stripped of its volatility and offered to investors who don't want to sit on Bitcoin. What we are seeing is the beginning of a structural liquidity event, and this is how you engineer a synthetic halving on steroids without needing a block reward change, a minor vote, or a blessing from a central banker. This is not driven by degens or nation states. It's being driven by the mom and pop bondholders who just want their 11% monthly checks. They don't care about Bitcoin, they don't care about yield, and Stretch is the first instrument in financial history that is telling people, we will give you your fixed income and we will buy an ultra-scarce digital monetary asset with it. This is Bitcoin replacing the monetary infrastructure. This is the new system that the capital markets is going to operate on. This is how the capital markets become our weapon, and this is how retirees in Boca Raton accidentally contribute to the greatest supply shock in Bitcoin's history because they're not stacking sats on their Robinhood app. They are pressing buy preferred on Schwab, and the second that money clears, Saylor is buying Bitcoin. Welcome to the next great rotation. Here's where the math stops being academic and starts becoming dangerous because Strategy's current STRC shelf is $4.2 billion. That's already been filed, already approved, and actively marketed. So this is the live weapon that's already been deployed, and it's proving that allocators are willing to fund Bitcoin-backed credit as long as it yields more than the treasury and doesn't smell like Dogecoin. Now look at this. If just 1% of that US money market capital rotates into this Stretch-style issuance that we're seeing, we will need more than 18 times the current shelf of $4.2 billion. You call that another round of funding? This is an entire new asset class forming overnight. This is Bitcoin-backed credit instruments coming to the market. As soon as the allocators are starting to see Stretch pay monthly yields that outperform every other fixed income product out there, and it's backstopped by 75 years of Bitcoin coverage on the balance sheet and 3 years in United States dollars. And it's been almost a year of zero missed dividends from Strategy with their digital credit products. What's going to happen when Strategy's balance sheet's worth $1 trillion with 5 years of zero missed dividends? What's this going to look like in terms of adoption? TradFi is not going to be able to resist. As soon as we start to see this Bitcoin black hole at scale, you're going to get the copycats. Think BlackRock, think Apple, think JP Morgan. And what happens if just 1% of this rotation scenario plays out? That is 0.86 million BTC bought directly off the market, more coins than have been mined since 2021, removed in one institutional exhale. And let me remind you, the long-term corporate holders of Bitcoin are never going to sell. Dead coins aren't moving. And BlackRock's IBIT and the other other Bitcoin ETFs are already hoarding the float like it's the last can of food in a bunker. This kind of pressure is not just going to move the price of Bitcoin, it is going to obliterate price discovery over the coming years. The buyers are going to chase higher and the sellers will continue to vanish, and suddenly you're not speculating about million-dollar Bitcoin, you are mathematically backing into it. This is fixed income liquidity in the largest pools of capital in the history of civilization being given a regulated, par-stable 11% reason to fund a Bitcoin accumulation strategy, and stretch is only the tip of the spear. Let's go deeper. So we've been talking about the US money market crowd like they are the whale, but they are not. This is the whale. We mentioned the $141 trillion that is the size of the global fixed income markets. Think bonds, think credit, think government IOUs, think corporate paper, the most boring and powerful market in human history, and now we are giving it a Bitcoin absorption mechanism. And here's the shocking part. If just 0.25% of that pile goes into stretch and stretch-style preferreds from maybe some copycats or some imitators or strategies other preferred equities, you raise $362.8 billion. Just that level of penetration, 0.25%, that buys over 4 million Bitcoin, about 20% of the entire supply, and it slams it into a corporate balance sheet. It's like rerunning Saylor's entire strategy, but from every pension fund and insurance desk on Earth. Now let's say that we hit 0.5% penetration. Because the bluff has been called from the sovereign debt that's out there, people don't trust the governments anymore. They would rather buy their income from strategy. $725.5 billion of capital gets rotated. That means over 8 million Bitcoin is bought. That is 40% of the circulating supply migrating to yield-seeking credit investors, fixed income allocators chasing these huge monthly coupons. If you do the math, that is 2 out of every 5 Bitcoin that will never see a Coinbase sell wall ever again. Because when bonds buy Bitcoin, it's not for trading, it is for yield-backed duration, and this is the ultimate pressure cooker moment. The more of the float that gets removed by stretch-like structures, the less there is for everyone else. The ETFs, the traders, the nation-states, the sovereign wealth funds, and of course, retail out there. You think the price went vertical with the ETFs? Wait until BlackRock's bond desk starts rolling 30-year treasuries into Bitcoin-covered preferreds. This is how this asset class of Bitcoin breaks out of the margin, not because of another 2017, 2021 retail mania, but because of the coupon math, duration compression, and capital allocators who haven't changed their underwear since QE1. A lot of people like to minimize this as calling it Bitcoin going mainstream. No, this is Bitcoin eating the global debt markets from the inside. And this is the part that the fixed income guys will not understand until it's too late. In Bitcoin, the price does not move linearly with the capital inflow. We know that's the case. We know that the price moves reflexively, exponentially, violently, because the supply is capped, the float is thin, and most of it is locked up by holders who would rather die than sell their Bitcoin. So when you push billions upon billions of dollars of yield-seeking capital into Bitcoin, you're not buying from willing sellers anymore. You are bidding against eternity. If you look at the academic studies that have been out there on this topic, well, what do they say? They put Bitcoin's short-run price elasticity between 5-to-1 and 10-to-1. Why? Because you're not just buying Bitcoin, you are convincing ghosts to part with them. So now let's apply that to Stretch, a $77 billion inflow, which was that 1% money market scenario, at 5-to-1 elasticity creates $400 billion of new market cap, and that alone pushes Bitcoin to $110,000 from today's prices, with zero ETF flows, with zero sovereign buys, and zero hype from the retail crowd. $386 billion inflow, the 5% case, that adds $2 trillion to the market cap. That is $200,000 per Bitcoin, purely mechanically, not emotionally, not spiritually, just mathematically. I'm not giving you moon math today. I am giving you liquidity math. It's the reason that equities don't 10x on $10 billion of inflows, but Bitcoin can, because when credit allocators rotate into Stretch, they're not buying exposure, they're removing the availability. They are shrinking the free float of Bitcoin while the rest of the world continually wants in. And this is how a boring fixed income instrument turns into a weaponized capital allocator, and this is how the yield-seeking boomers accidentally set off the Bitcoin supply shock. And this is not just why STRC is buying Bitcoin for Michael Saylor, it is amplifying the Bitcoin price. This entire playbook works, but only if 4 things happen in sequence. Number 1, par stability has to happen. STRC has to stay at near $100 in order for it to replace the money market accounts out there. If STRC trades at a persistent discount, every dollar raised becomes more expensive, more dilutive, and less scalable. The ATM stops working, the flywheel stalls, and the capital loop just breaks. Par stability for STRC is the oxygen, so we need the volatility to drop. It's been trading at par value all this week, but we have seen sell-offs after the dividends have been paid out. If there's no $100, there's no issuance of STRC into the market, and no issuance means no further Bitcoin acquisition. And number 2, the dividend appeal. The spreads need to stay high, the yields need to stay high, the coupon has to beat the treasury bills, not match them. I'm talking beat them by 500 basis points, because right now this seems to be the threshold where conservative cash allocators will start to think a little bit. If STRC is yielding 11% and the Fed's printing 4.5%, you are in business. But if the T-bills close the gap somehow, we know that's not going to be the case because the Fed is going to be cutting rates this year, which means that more capital is just going to flow into STRC. But if the T-bills ever do close that gap, you're competing with the so-called risk-free rate until STRC becomes the new risk-free rate, of course. And no chief investment officer wants to explain that decision on a Monday. And then if you look at the regulatory and infrastructure plumbing behind this, you got to look at the clearinghouses, the custodians, the broker-dealers, the settlements, pipelines. Any operational friction at scale just needed to totally disappear. So all of the money market managers out there must be able to treat STRC like any other preferred. You push a button, you book the trade, and then you move on. If your Bitcoin-backed credit product cannot clear smoothly through DTCC, it is dead on arrival in any preferred equity market. Luckily, that doesn't seem to be the case, but it's something to pay attention to the next issuers of digital credit backed by Bitcoin. And that brings us to the copycats. This is the tipping point. Once strategy proves this model, we need at least one Fortune 500 clone out there with some common sense, because that's what's going to normalize this structure. Think of an S&P 500 company doing this. This is what unlocks mandates. This is what makes the chief investment officer at CalPERS say, okay, I guess we can hold Bitcoin as long as it's wrapped in yield, and that is the entire ballgame. And every single one of these steps is achievable because we're already past a few of the steps. We know that STRC is live, the shelf is filed, the product is trading at par, and the capital is rotating. Next Monday, mark my words, you're going to see a big Bitcoin buy from strategy just utilizing this exact playbook. And once this foundation becomes entrenched, it is more in place over time, the imitation is going to become inevitable because the capital rotation is going to become unstoppable. This isn't about convincing crypto people to buy bonds. It's about convincing the fixed income investors out there who are not even buying the apex asset of Bitcoin. We're convincing them that they can get a better yield because of Bitcoin. As put as simply as possible, it is about convincing bond people to buy Bitcoin without even knowing that they did. Every single one of these milestones is totally realistic, and it's realistic in the next few years. We're going to see the copycats come out. We already have. Strive and Metaplanet are issuing their own preferred equities, and now it's all about operational credibility. We're looking at the par trading. We are looking at the consistency of these monthly dividends, custody clarity, and the first imitator from a bigger company than even strategy itself. If these things happen, STRC isn't just going to raise money, it is going to rewrite the rules of Bitcoin adoption through fixed income. My name is Adam Livingston. I am the Bitcoin Wizard. Thank you so much for watching this transmission from Swan Bitcoin. We are here on the front lines giving commentary on the greatest wealth transfer in the history of humanity. We're talking about trillions of dollars flowing into Bitcoin, and if you want to be positioned before this shift happens, Swan Private is for you. Swan Private works with high net worth families, family offices, and you to be secured with your Bitcoin position before this shift happens, and we help you do it securely and strategically. If you want to build a generational Bitcoin position for your family before Michael Saylor buys all of the Bitcoin that's out there, we can help you every single step of the way. Go to swan.com/no second best to learn more. Have a terrific day. Do not party too hard. Class dismissed.